Hey guys, welcome to The Market is Open. So, I wanted to do a video on Southwest. The airlines are quite interesting right now. It's in early May. Warren Buffett yesterday said he sold all his airlines. Was he correct? Was he wrong? We made a video about Warren Buffett's portfolio where we agreed with his airline sales. At the same time, I'm an opportunistic investor and I like it when people are running out of a stock. So I wanted to do a more thorough analysis. I did one of Southwest. I could have done any airline. The reason I picked Southwest is because if the cream of the crop, Southwest can't survive. Southwest had basically no debt before this pandemic started. They only had around $2 billion. If they can't survive, it's likely that all the other airlines can't survive. So that's why I wanted to do an analysis of Southwest. So I built a DCF model and hopefully we can run through the inputs. I made some assumptions and we'll go through that. And this will help you determine if to buy Southwest. Obviously, this isn't financial recommendation, just a model that I built. Some of the assumptions are simplifying and I would have improved it, but I built this model in about 3 hours and I wanted to go through it. So historical shows what the company has either before or today. So this estimated today is my analysis of what the company has today. So I just wanted to show you quickly first. So before all this incidents, Southwest had long-term debt of 1.8 billion and 2.3 billion, but now I estimate today it's 14.9 billion, and this is how we get up to that number. So the current debt, it was before the crisis was about 2 billion, but before the quarter ended in March, they had already issued about 3 billion, and this is paying around 5%. They've drawn down another 2.2 billion from their credit facility since the quarter ended, and that's also around 5%. The payroll support program, some of it, the 1.6 billion, is not a loan. It's actually just free money, and I'll show you how that plays in the valuation. There's also, the government gave them 948 million ultra low interest loan. That's at 1%, but we actually have to look at the dilution on that. So the government says, hey, you're going to have to give us 2.6 million shares. And originally I was somewhat critical of the government. I thought they were going to take a huge equity stake, but it's actually quite reasonable to give 948 million, and they're only going to take 2.6 million shares. If you think about it, 2.6 million shares times $30 is only about 60 million. So the government really didn't take a lot of warrants. I thought they were going to take the amount of warrants basically equivalent to what the stock was at. So if they gave 948 million, I thought they would take at least 30 million shares in warrants, but they were actually quite nice in this. So they could have been very punitive, they could have been very lenient, and the government did take, a way more lenient stance than I thought. Southwest also issued another 2 billion at about 5.3% on April 29th. Around this time, they did another 2 billion of convertible bonds. This is also at a low interest rate, but again, we need to factor in the dilution. That could be, so the interest is low, but it could be another 52 million shares, and that is at a convertible price of 38.48. I think it's over the next 10 years. Then they did 2 billion of equity issuance, and obviously this is at 0% because it's equity, and this is 70 million shares have already been added. So I already issued Southwest 2.8 billion. They actually haven't received this money yet, but for the model, it's just easier to assume they're going to take the money. I think they're going to take the money. This interest rate is about 3.5%, and Southwest has applied for it. They haven't taken the money, but let's just assume they take the money. The warrants give them about 8 million shares. So most people will say, if they've done their math, that Southwest has 19 billion minus this 2.8 billion because they technically haven't received it yet. Just for simplification, again, I took it. To estimate today, I kept all the accounts the same except for the cash and the debt. And obviously this makes sense because nothing much has really changed since the end of the quarter to today, except for the fact that Southwest has, raised a lot of cash and they've issued a lot of debt. So then this sort of runs through the model and you can see cash shrinking and you may wonder why. And so that brings us to the next part of the model, which is the revenue part of the model. So you can see the black part is just, the black part I've just eliminated for simplification because we're not going to use these accounts. So Southwest uses capitalized interest. Capitalized interest, you may wonder what it is, but it's just a company not expensing interest expense, but it's actually, they're losing cash when they do it. So I just ignored it and treated all interest expense as an expense and not capitalizing any of it. So Southwest had 22 billion of sales last year. I estimated this year, so I'm looking actually at the next 12 months starting today from April rather than looking at the first 3 months of the year. Again, it's just easier to model a whole year from today rather than incorporating the 3 months of results we already know. So this is why you'll see their sales at 2.2 billion, even though they obviously had much greater sales from January to March. So I'm saying over the next 12 months, it should be 2.2 billion. And the reason why it's not zero is because some people are still flying. That's one. I mean, traffic is down about 90 to 95%, but also most of these companies still make a little bit of money in cargo revenue. The other is the grant revenue. So the accounting rules, this could be in part of revenue or it could just be part of this cost item. It doesn't really matter where you show it. The fact is, this is profit for Southwest. So they're going to have 3.8 billion of revenue. Southwest said they're going to have a cash burn of $32.50 for the next 4 months. So this is how we get this number. And then I calculated what the salaries would be after that until the end of April. So that the way I did that was if we look at Southwest, they spent 8.3 billion last year on salaries and wages for 60,000 employees. I estimate that Southwest after September will reduce their workforce by about 60%. So that would bring them down to 24,000 employees. The average pay was about 136,000. So I'm simply looking at the 24,000 employees times 136,000, but I think everyone will get a pay decrease of about 20% and then multiply that by 8/12. So that's where you get this number. That's about 1.8 billion. Then I'm going to calculate severance. So not all companies have to pay severance. Southwest does because 83% of their employees are part of unions. So that is about the 556 million. That's for the 60% of employees fired. This 725 is oil costs. So the reason it's divided by 2, as you can see in the top, is because the oil price is half of what it was last year. So that 4347 is based on about $2 a gallon of oil. And the reason I did 8/12 is because the cash burn for the fuel is already incorporated until September. That's what Southwest has already guided and told us. So the reason it's also divided by 2 again is because Southwest is going to have a lot less flights. So that's sort of based on the logic the same for this maintenance is we're going to multiply it by only 8 months out of 12 because the first 4 months is in the cash burn. And then we're going to multiply it by 50 just to bring it a little lower because they're definitely going to reduce these employees. The depreciation is going to stay the same because aircraft still depreciate the same amount over the year, and we're going to get into that just looking at their capital expenditures. The other operating expense will be much, much lower. So a lot of the operating expenses, what they pay companies like Expedia for when travel is booked. So Southwest says other operating expense consists of distribution costs. That's money given to companies like Expedia, and Southwest will not be spending much on marketing. So this number will decline. This gets our total operating expenses of 9.3 billion. Their operating income is therefore going to be negative 5.5 billion. Interest expense, so this is calculated 599. If we go to the top, we look at all the interest from all the loans, and you can see that's 599 million. Their interest income, so they're actually going to have cash on hand, and that's calculated at looking at sort of their average cash balance for the year. So that's going to help them and make them 163 million. This means I think from today going forward for a year, Southwest is actually going to lose a huge amount of money, negative 5.9 billion. They're going to get back some money in taxes. So I say Southwest will lose 741 a share starting from May to the next April. So then we go to the cash flow statement to help model it, and we saw their net income. You add back depreciation. Their accounts receivable, since accounts receivable will be going down, that means customers are paying Southwest, and Southwest is not extending money to customers. So that means Southwest is going to have more cash. Their accounts payable, since Southwest is going to be flying less, they're also going to be paying down their accounts payable. That goes down negative 1.3 billion. Just to run through a quick transaction of why that's going down. So this 522 million last year it ended at 1.04 billion. So if Southwest has less employees, then the prior employees have already been paid. So obviously they're going to have less accounts payable for employees. So that number is obviously going to go down. Accrued liabilities, if they pay out employees' vacation pay, obviously that is going to be lower. So that's just an example of why the accounts payable would be down. Therefore, that money has been paid out. Therefore, cash is lower. Southwest has said they reduced their capital expenditures by $1 billion. You may wonder that's higher than last year, but it's more in line with 2018 and 2017. So Southwest had guided that they would spend about $2 billion of capital expenditures this year. So that leads us to them losing about $1 billion in investing activities. Then financing activities, I don't think they're going to do anything over the next year in terms of paying back debt. I think it's all hands on deck. We're very scared for the next year. So therefore, cash and cash equivalents will end the end of April next year at 14.2 billion. So the next 2022 is where we get a bit more interesting. I said they're going to fire 60% of their employees. So I said 60% of revenue will come back by starting from May 1st, 2021 to the end of April 2022. And then we could simply run through the model again, where salaries and wages this time is still going to be lower by 80% because I believe employees will take a pay reduction. So this is what 40% of Southwest's workforce will cost for the year. Fuel and oil is based on 40% of flights flying, and oil and gas being about 30% lower. Maintenance and fuel, it's based on half because I think Southwest will need to maintain some of their planes that they're going to have in storage, which is why I'm not reducing it by 60%. This may be a little higher, we'll see. Landing fees would be 40% because they're definitely going to have less planes. Depreciation and amortization is about the same just because their capital expenditures are about matching their depreciation right now. So there's no reason to believe depreciation is going to be substantially different. Other operating expenses, I have a base of $605 million that they can't really go below. And I'm going to add 40% because more people will be traveling and booking through different websites. So that gets their operating expenses of $8 billion. And Southwest is actually profitable, at least in operating income, in year 2. Then they'll have interest expense of $599 million, interest income $147. That means they'll have 50 cents a share profit for that period of time. So that seems pretty good. Then we run through the cash flow statement. Considering Southwest as income now, they'll be more confident and they'll pay back $5 billion of debt, meaning they'll end the year at $9.9 billion of cash. Okay, so the final year that we run through, and we'll get to the valuation model in a second, but Southwest 70% of revenue comes back by 2023, and that's the year May 1, 2022 to April 30th, 2023. And under this model, they bring back 70% of their employees. Their fuel and oil costs, we'll say oil drops and it's maybe 10% below by that time. And then all the other costs we run through. Then we get Southwest makes operating income of about $1.3 billion. Interest expense is lower because they paid back that debt. And then we get Southwest makes $124 a share in that period. And Southwest, again, is more confident. So they're going to pay back $5 billion of debt in that period. They're going to end with about $6.2 billion of cash. So let's just run through the DCF model. So Southwest is going to have operating income. We showed these numbers before, year 1, 2, 3, and then year 4, we're going to say they're going to return to complete normal. And then year 5 is, again, we're going to say, they're back to normal, but we're going to be a little conservative and we're not going to grow earnings from year 4, year 5. So we have the interest expense. We have then that makes them earnings before taxes. We add the depreciation, we less the capex, the change in net working capital, which we showed in the cash flow statement. Then we look at how much debt they repaid. Since they're not repaying any debt in year 1, that means they're going to have negative $4.8 billion of cash for shareholders. And then we discount that. So we discount all these values. And year 4, we're going to just say, again, no cash for shareholders because they're going to pay back debt. And then by year 5, they're going to have about the same amount of debt that they had before. We're going to assume Southwest continues to carry a little more cash at around $6 billion, but not much more because you can't really carry much more cash than $6 billion. If we then say they're going to have operating income of about $2.4 billion, which is what it was in 2019, so we've sort of gone back to the future, and then we say they can grow, their discount rate is 8%, and they can grow that terminal growth rate at 3% perpetuity. That would be about 34,870 discounted. That would mean $35 billion. Then we add up all these numbers, and that gets us $23 billion. There's 639 shares outstanding. That's when everyone converts. And then that would equal a price of about $37.1. I actually think the discount rate is probably closer to 10%. But remember this, when things look like they're going to be good for shareholders, that would mean investors would be willing to give it a lower risk or discount rate. So the valuation could shoot up very quickly. When we use an 8% discount rate, we get 37.1. When we use a 10, we get 19.4. I think the value is somewhat fair between those two prices. Probably the lowest price you could see is 15. I mentioned in another video, the Buffett portfolio video, if it goes to 15, I'd be more interested. So that's sort of the value investor price. Just some concluding thoughts. So I disagree with Buffett. I don't think the world is going to change much. And I don't even think really Buffett thinks the world is going to change much. I think he just thinks this is an elevated concern on top of the fact that all these airlines have liquidity issues that have to sort of rely on government to survive. I think business travel will come back. 45% of air travel right now is businesses. And I mean, travel will come back. People want to go on vacation. Most people want experiences in their life. So people are not going to sit at home. This, if anything, will make people want to travel more because of how little they did in their life, maybe for the next few months. So that actually will accelerate people. For businesses, yeah, okay, businesses are going to be like, we're not going to do any air travel. This is dangerous. Okay, so they say that. And then your competitor flies all his consultants over, and then they close that deal because one consultant talked in person and you decided to sit at home and do a Zoom meeting. So you're going to lose the sale. Who's going to win the sale? Then that business the next day is going to say, okay, we'll send consultants out. So it's sort of why oligopolies or cartels collapse. So one person in the cartel then undercuts another member of a cartel. And that's sort of what it will be like. If you want to compete on Zoom and the other guy says, well, I'm willing to fly out my guy and, wine and dine you, take you to an event, take you to a restaurant, who do you think is going to win the deal? So business travel will come back. Yeah, there's no reason to not think it will come back. It definitely could take a couple of years. A lot of people in the airline say 3 years. That number kind of makes sense to me, that the reason why some of it may take a bit longer is because if everything improved by September, then airline travel could come back right away. But if Southwest has to take actions to fire employees, then there's going to be sticky costs where they then have to rehire employees and everything, and then you have to train people. So once airlines cut capacity, it's hard for them to revamp, and airlines sort of have to cut capacity because they can't have 100% of employees on their payroll for an unidentified period of time. So that's why I think it will take a while to come back. I think if the government wanted to just bankroll or nationalize airlines and then just eat the losses over the next bit, then I think airline travel could come back a lot quicker, but I don't think that's a desirable option. So I hope you guys enjoyed this video. I'll leave this model in a link or on our Patreon site, and let me know in the comments what you think.